investor alike, startups, funding and dynamics. Our goal is to move beyond the basics and provide you with a deep understanding of the capital landscape. We are thrilled to have a distinguished audience with us today, ranging from aspiring founders to seasoned angel investors and definitely well-educated dignitaries. We will cover a few of them as we go. As the brand tagline of Finkasturi suggests, we are here to assist you in building wealth and nurturing success. We invite you to engage fully with this session as we explore the strategic roadmap for financial growth. Throughout the presentation, we'll bridge the gap between startup risk and long-term financial security. Please take a note of our contact details on the screen should you wish to reach out after the session. Let us begin this journey towards a more informed investment future. So before we proceed, we'll have some housekeeping things to take care of. So we'll start with the disclaimers. Okay. I'll just give a brief update of the session flow. So we will have the introduction to Finkasturi. We'll have a quick economy and securities market outlook. Then we'll go to the main topic by Dr. Kishore Nuthalapati on startup funding and dynamics, and then we'll have a Q&A. We also will share a Q&A forms link where you can post any questions which we cannot cover today. Going to the disclaimers. Please do note, investment in securities markets are subject to market risk. Read all the related documents carefully before investing. Registration granted by SEBI, membership of BSL and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors. A few housekeeping things that we would want everybody to know. The session has been recorded. The recording will be made public as per regulatory guidelines. Your participation in the session from this point forward is deemed to your accepting the recording of the session. We do request, we will not take any stock or security specific questions or queries during this meeting. Request all of you to keep your video off and audio on mute. If any questions, you can post in the chat window. All the chat questions will be taken up at the end. So we will start with introduction to Finkasturi. We are a SEBI registered investment advisor. Our firm provides specialized investment advisory services to a diverse range of individual and institutional clients. Our core objective is to maximize yield for our clients whilst strictly with their defined investment objectives. We take pride in our deep experience in the capital markets, which allows us to navigate a wide array of asset classes effectively. Our operations are built on an ecosystem of trust, integrity, and transparency. Our firm is led by a team of seasoned professionals with over half a century of combined experience. Dr. Nirakar Pradhan is a PhD, CFA, and a FRM. He is the Chief Investment Advisor and Director of Finkasturi Nivesh. He has over 35 years of experience in financial markets, 25 years with SBI and then with the Generali Group. Myself, Ashwin Albert Dsouza, I have around 20 years of experience in IT and financial markets. I am the CEO and the Director of the firm. We are supported by Aman Maurya, who is a chartered accountant and is a VP of the firm with years of experience. We also have Neville Montero, who is our Vice President of Operations and who ensures our daily functions run seamlessly. He has 7 years of experience. Okay, so this combination of technical and financial insight is what helps us to provide cutting-edge advisory services to all our clients. I'll move on to the services that we provide. Focusing on individuals. So we empower individuals in the startup ecosystem as well as individuals on an individual basis for the retirement and other services that they require. Our core expertise is financial planning for individuals and corporates. We also provide stock portfolios, ETF, mutual fund advisories, and customized advisory for any specific financial decisions. We focus more on the discipline aspect when it is for investments rather than looking at maximizing for the highest. So continuing, so for startups, for startup investors, okay, so we provide a comprehensive financial planning as well as portfolio advisor, and we do the asset allocation in a very strategic manner, so that any angel investing requirements that they have, that can be taken care of from their existing portfolios without putting any stress on other assets or their other investments. For startup founders, what I would say is, for startup founders, they need to ensure that they have differentiation between the startup and their own personal financial planning. Okay, we'll help startup founders on their personal financial, manage cash flow volatility, because salaries or money flow will be very fluctuating. How to take care of that? Risk protection on your personal level, and then how do you balance salary, equity, and your long-term wealth creation. Going to startups or corporates, we provide institutional grade financial discipline. So things like, we provide a robust treasury management framework for your startups. Also, we help you plan strategic liquidity and runway planning, so that a long-term survival of the startup through meticulous cash flow projections, you can take smart decisions, strategic decisions, how you can manage whatever scarce resource of cash flow that you have. Okay, and of course, companies that have surplus capital, we will help you to efficiently deploy that. Okay, so these are the main things that we Finkasturi specializes in. With this, I will hand it over to Dr. Nirakar to take it forward with the market outlook.
Hi, Ashwin. Thank you. Namaskar. Very good morning. Hi, everyone. Ladies and gentlemen, it is a great privilege for Finkasturi and for me also. This is a proud moment. As Ashwin introduced myself, my name is Nirakar Pradhan. I have got about 35 years of experience in financial market. Couple of minutes, I will take you through what is happening and what is my experience. I have never seen a better moment in my life, last 40 years of career, better moment for India as a country, India as an economy, India as a society. When I say that, what do I mean? They call it Sangam Yug. Means many things come together. This is called confluence. They call it Amrit Kal. You know Amrit Kal? Just before sunrise, 1 or 2 hours before sunrise. Why this is auspicious? They say, whatever you think, whatever you dream, those moments, that happens. You become successful. So what happened 1 year before? Last January, February, you are a spiritual person. You have seen Sangam, Mahakumbh. 66 crores Indian came, 45 days deep in Ganges. Then no violence. Can you imagine? This is the largest peaceful gathering in the world. Record. Right? 2 days. Okay. There is a 14-year boy, Vaibhav Suryavanshi, 80 ball, 25 runs. And our team, 411 runs, beat this team. And what is British team? We learned game of a beaten with British team by 100 runs. Social side, we are doing well. What about the projection by region? This is from world. Just look at the left-hand side, top left-hand side. Last year, world GDP growth. It is 3.2%. 2026, this current year, forecast is 3.1. Again, what does it show? 2 years ago, 3.3. Last year, 3.2. This year will be 3.1. Is it increasing or is it going 3.5? That means even after 5 years of economy has not recovered. But Germany, all the developed countries, they are strong economically. Next slide, please. Friends, but when you come to India, the new different. When I say different, it is what? You see, last Yes, see, 2000, I think January 2020, we got the COVID. 2020, 21, everybody suffered. But last 4 years, you see, what is our growth? Average growth is a little higher than 7%. What was our growth rate? Below 6.5. Before COVID, below 6.5. After COVID, above 7%. India is the only major country. This is the only exception in the world. So you can draw your conclusion. Next slide. Friends, as we discussed, India is doing very well. Socially, economically, spiritually, in fact, all aspects of our country. What I think is we all have to come together to understand what is happening all around us, what are the opportunities, rather than we act big and achieve big. Look at what government is doing. Economy, last year, you are having 10 lakhs income. If it is 2 years before, you might have paid some 50,000 or 1 lakh tax. But last year, they increased income tax limit from 5 lakhs to 12 lakhs. That gave about 1 lakh crore worth of money in the hand of small taxpayers. Recently, there was GST rationalization. What does it mean? It gave about 2 lakh crores of worth of money among consumers. Last union budget, few days ago, it announced 20-year tax holidays. Suppose you can build this data center. Whatever your profit, next 20 years, you will not pay a single paisa tax. This is the government thinking. They are thinking big to make India, because it's a developed country. Today we are, I think, 4th largest economy in the world. We want to be 3rd largest within another 10, 20 years. Looking at the market, after COVID, look at what has happened. Our corporate earnings, because of last 1 year, 2 years, there was a war, geopolitical tension, 50% tax from USA, corporate business impacted. So earning was less than 10% last 2 years. Okay, but come December quarter, current quarter, the earnings for the first time it has exceeded 10%. Our expectation is that coming year, this time it will be around 12 to 15%. So corporate earning is going up, and our domestic retail investor like you and me, they are coming and investing. They have transformed themselves from saver, that is saving from bank deposit, to investors, investing in stock market, mutual fund, PMS, AIF and all that. And our stock market with a reasonable valuation and a recent USA-India trade deal, it has boosted our sentiment. And what is the outlook? If I look at short term, let's say less than 1 year, I think volatility is likely to continue. But you are trying to build wealth, and the horizon is 5 year, 10 year, then this is the best time to be in the Indian stock market. As Ashwin said, Finkasturi, we are here. We want to be a bridge between you and your dream, between your past and future. We are here to create the future success story. You are always welcome to connect with us. With these few words, I will be very happy. Next slide. To welcome our mentor. He is our guru. Daily life, he has been mentoring us. Our corporates in Odisha. He is known as Mr. H.K. Behera. He retired as a top manager in Union Bank of India. He is a transformation leader. Last 10 years or so, even during COVID, he is working 24/7 to promote industry, because the industry is where our hope is. Sir, over to you, Behera sir. Kindly inspire us with a few words. Thank you.
Okay, very good morning to everybody. Nirakar, many thanks for this giving opportunity to me. Really, at the outset, I really say a few words. Dr. Nirakar Pradhan is a great visionary for his whole heart and soul for the entrepreneurs development, people's developments. That's really thankful to. And this webinar, really I'm proud actually, is a really appropriate for a startup and entrepreneurs funding. for them. At the outset, what I learned from this webinar, I really welcome to Dr. Kishore Nuthalapati. Really is a financial economics, having large number of qualifications and doing wonderful jobs. Really, definitely your insights, ideas, thoughts will be benefited large startup entrepreneurs. Thanks. And secondly, today we have Mr. Ashwin Dsouza ji. He's also CEO of a security market, PGP security market company also. His idea and thought also is more beneficial. I said two few lines actually. I retired from the Union Bank of India General Manager. And a lot of people saying the startup space entrepreneurs facing a lot of problems of funding, financing, and guiding in the financial market. Then we created Odisha Corporate Foundation in 2019. We have been continuously doing National Startup Conclave, State Club Awards, and we want to connect large number of mentors, guide who really can guide our startups, entrepreneurs in regular basis. This is our journey. As much you can do for them, it's great. When we gathered, in many occasions we gathered 300 to 400 startups and invited large number of mentors, corporate people, leaders. They excited that today a lot of people are coming together to help startups. That is a great opportunity for all of us. And I hope this seminar will be larger benefit. And I appeal to everybody, not Nirakar sir, also Dr. Nirakar. It is not one day we can teach them. In the class, I say to students, parents, that up to graduation, post-graduation, it takes to a student, a boy or girl, to mature enough to do either service or a business. It's a journey of our life. It's a journey not 1 or 2 days. So we need a continuous guiding and factor guiding to them. And I hope today we have eminent people. Definitely it will be go long way to benefit our startup entrepreneurs. Thanks, sir. Thanks, sir.
Thank you, Vera sir. Thank you so much. It's wonderful, inspiring words from you. And we'll certainly will work hard to bring success. With this, now a few words about to Dr. Kishore, our industry expert this morning. Sir, thank you very much. It's a hearty welcome to you. And Ashwin, we have that slide on Dr. Kishore. Yeah. So, friends, as you can see from the slide, he is one of the most reputed industry expert. He is PhD in finance. He is CFO and Director at BEKEM Infra Projects. He is my friend, philosopher, guide for last 10 years or so. We both are working closely together how to develop our country, how to create a job opportunity for the young, educated, unemployed, and also help startups to create to join all the value chains, whether the technical expertise, the financial expertise, leadership skills, and all that. So without taking much time, sir, I extend a hearty welcome. It's over to you, sir. Dr. Kishore. Thank you, sir.
Thank you, sir. Thank you, sir. Thank you, sir. With your permission, I will take the presentation from my side.
Yes, sure. Go ahead, Dr. Kishore.
Please, sir.
We can see the presentation now.
Thanks to Finkasturi, one among the rarely found boutique investment advisory firms registered and rendering services with focus and within the laws. More appreciable, the huge knowledge backup what you have, translating into the legitimate, legally permitted, and within the laws, whatever is compliance required, 100% complying with that, that is highly appreciable. And the series of knowledge sharing sessions, what you are conducting for the benefit of investors, startups, prospective entrepreneurs, and the researchers, academicians is highly appreciable. My sincere thanks. And without much ado, I will proceed with the topic of the day. We have seen challenge among many startups in mobilizing funds. This is one side. On the other side, we have seen many investors who are longing to make investments into startups, but are not able to find right startups or have burned their fingers having made investments in either wrong startups or at a wrong time or funding wrong proposition. So we always say, if a startup is not able to mobilize funds, the problem could be one or more of these three. First one, the business proposition, the concept itself. Second, the promoter of the startup. Third, the pitch, what is made by them. If they are not able to mobilize funds for their startup, problem should be in one or more of these three. On the other side, for the investors like you and me, who definitely love to make investments in startups and be part of their prospective journey and get returns, if we are having any issue, it could be in three things. Number one, not understanding what the startup is. Number two, what are we funding? At what stage are we funding? What are we funding? And how are we funding? Number three, at what valuation are we funding? So these are the plus and minus of both the sides. A brief disclaimer, small disclaimer, and this disclaimer includes the mention of Finkasturi leadership, who disclaimed the statutory regulatory things, what they have done under BASL and SEBI regulations. So we respect that. Now, startup investments are very prosperous. That's one reason why we find the best of the names, the most glamorous names in the country, including Deepika Padukone, Ranbir Kapoor, Alia Bhatt, Amitabh Bachchan, Sachin Tendulkar, and the likes have been making investments into many startups. They also made a lot of buzz with their co-partnerships and with huge returns what they have earned. Of course, there could be few issues as far as the other aspects are concerned, but broadly, they made a lot of buzz with investment activity and also, as we understand, with huge returns, as could be seen from the values of the portfolios they are holding as per the public information. There could be few more which are private. The reason why they are prosperous, the reason why startup investments are prosperous are they have a lot of attractions. Few of them include you get to meet a wide network, a very prosperous network, a glamorous network. You have pride in making investments in startups and being part of the contribution happening from the startups to the economy. And you earn huge reputation for being an investor. Apart from these, or along with these, high returns, what are evidenced by the other startup investors. There are only two ways to make big money, either through investments in financial instruments, including equity debt, or by being in politics. We'll not talk about politics. There is only one way for us, legitimate, formal, respected way, which is investments in equities and the other instruments, which will give you multi-fold returns. We have seen startups such as Google, startups such as Infosys in India, Microsoft, all of them were startups, and the promoters like you and me, or maybe even from the lower middle class profiles, have become multi-billionaires, the richest of the world, only because of their value appreciations from their investments into their own startups and subsequently into other startups. If these are so good, so prosperous, what should stop us? What is stopping us? There are certain things which are involved in the process of investment in startups, and one should be cautious about these things. One should engage a proper financial advisor or have association with a proper financial advisor consultant to proceed, because investments in startups have high risks. They require focused due diligence, expert due diligence. They require continuous monitoring until you exit. And a lot of documents could be required to safeguard the interests of the investors. Because these are involved, startup investments are prosperous, but they need the advisory service, cautious approach, or our own expertise if we build over a period of time. The reason is we should not romanticize what we are investing into the startups. It sounds very glamorous, it sounds very a matter of pride, but that should not be sufficient, because the worth of the business is not what you're putting into it, what you can take out of it. So at the time of entry, at the time of investment into a startup, you may be elated, but that elation is real and valid only when you exit with the expected return and not otherwise. This quote was given by none other than the securities market master, the father of SAPM, Benjamin Graham. You can imagine now how many decades old this quote would have been if it has come from Benjamin Graham, who was the guru, the master of the world's successful investor still living in legend, Mr. Warren Buffett. So Benjamin Graham tutored Warren Buffett, was a professor, partner, tutor, guide, philosopher, and created many, of course, Ho and many others also were created. But the most popular name, what we use immediately as an example, is Warren Buffett. Now, what is funded in a startup? When it is funded, what stage we'll see later. But what is usually funded? In a startup, the funding requirements, right from the bootstrapping, seed funding, series funding, and exit funding, could cover these things as per the stage. Setup costs, the personal living costs of the startup founder. If you recollect in the Finkasturi's presentation, Mr. Ashwin, the CEO, Ashwin has stressed upon one word, runway management. Startups ought to have the funding pre-mobilized, understand the runway required, hold the money for the runway, and use it for the runway. If that runway funding is not properly planned by a startup, it is doomed to meet with failure. Even if the concept is good, market has got the viability approach, acceptance, and the utility, the users are eager, and all is good, still. It is liquidity, what is provided by the runway planning, and that runway planning requires an expert mind to understand what is the burn rate, at what rate will it accelerate to burn, how much fund is required, when should the next funding round happen, until the next funding round happens, if it is required. Does this runway fund meet our and growth story and keep us solid, liquid, and going at the same pace of our planning and growth? These all things are not so easy to understand unless we put our brains and do a bit of research and make investments and gain experience, or when we work with some consultants like the good names what we speak generally. The personal living costs and the research costs, the network costs, a startup need to be known as present in the space. Today we are talking about eVTOLs. We spoke about eVTOLs about 4 years back when people laughed that there may not be electronic vertical takeoff vehicles like helicopters, like smaller size helicopters, bigger size drones. People laugh, but today they are a reality. Those who funded that are now minting money, multiple returns because of their foresight about the requirement. And which all startups were in that space, which all have made good network, only could find good deals. Others could not strike good deals. So the networking has costs, which a startup investor would understand with maturity. A typical lender, a typical investor may not understand, may not appreciate. It is only with the maturity of having made startup investments or the guidance by an agency do we understand what needs to be funded, what are required, and therefore the funding what we are giving is meant for a purpose, for a right purpose, for a right growth path. The sales commissions wherever required, the team costs, travel costs, the prototype and demo costs, proving the market viability product and proving the market acceptance and proving that the scale will hold the feasibility for the product or for the startup. Consultant costs, do not look down upon a startup if they say, we have hired this consultant to advise us on market approach, to advise us on funding, to advise us on product scaling. Consultants bring enormous value to the table and will guide the startup, avoid the pitfalls before pivots. More pivots is not glamorous. It sounds good. Someone would say, I'm a serial entrepreneur. I have already founded 8 enterprises. What are the 8 enterprises doing is a big question. And why, if the first, second one are so successful, you are in the series, on the path, in the race of finding more startups. One Google is good enough for the whole world to shake and look like in next century, there may not be anything to match, to compete exactly in the same proportion like Google. Those are the kind of startups that one has to plan and put efforts and achieve than being into multiple startups, unless many of them are successful or they have purpose. Their path will progress, and plan A, plan B, plan C, as per the situation, may require shifts in your business plans, which we call them in our startup language as pivots. Fewer the pivots, better it is, but pivots are not dirty words. Where they require, we should adopt pivots and keep the startup growing faster. In any way, at any cost, plan B should not be opposite of plan A. Plan C should not be opposite of plan B and plan A. Plan A and plan B and plan C should be of the same family. Small change should be plan B. A further small change should be plan C. If it is not a small change from plan A, a reasonably meaningful change from plan A, if it is a different plan, it is not plan B, it is another plan A, which means you are abandoning your earlier startup and planning or dreaming another startup which may meet the same fate of the past abandoned startup. These all things hold a lot of value, a lot of insights. And we need to understand what is funded, how is it funded, what stage is it? Is it pivot funding? Is it growth funding? Is it startup funding, viability funding? Or is it IPO funding, exit funding, or distress funding? So let's say winding up, closure, a merger, or acquisition by someone else at a distressed price. We need to understand that. Promotion costs, of course, self-explanatory. Break-even costs. There is a big insight into this break-even cost. Whenever we address a lot of startup founders, we are surprised to understand that they miss a very key aspect. Until you break even, you incur losses. From the point you break even, you have profits. Excellent. Very glamorous statement. That doesn't mean the day you break even, you recovered all the losses you incurred until then. And who will fund those losses? Who funded those losses? Where has the capital come to fund your losses? One needs to understand that the break-even point is very important for this reason, that until we break even, we may incur losses. We do incur losses. All these losses should be funded by capital, the patient capital, which matches the break-even point. That fact has to be understood by the startup founder first, not the investor. Startup founder has to understand that and explain, convince, clarify, and get the concurrence of the investor. Only then will that partnership prosper until you meet your exit targets. So break-even costs have got that insight, which many miss. How many? 99 point odd miss that point. And of course, funding costs. Your business is running smoothly. You don't need any more funds. Everything is smooth. But to make IPO, you need an amount of 50 crores to 120 crores for various purposes, including promotion, including regulatory aspects, including capital restructuring, including other consultancy services, all of them, and road shows, etc. Who would fund them? Your business may not be able to fund. Sometimes, just to meet these costs, startups which are premature, just about to go public, will also mobilize funds. So funding costs and the consultant who is arranging funds for you, equity funds, convertible funds, or at the right time debt funds, or the pre-IPO, IPO funds, they all need to be paid. Those costs are also funded by the investors. And come growth needs. The startup is doing well, succeeded with the product, is known. Unless it grows, it cannot be static. There is nothing like static in business. Either you grow or degrow. If a business is not growing, when the country is having an inflation presently of 2% and traditionally of 5%, unless your business grows at least at 5%, it is degrowth. It has degrowth. So understanding this concept, and unless you hold your market share intact, if not increased. There is no growth, there is nothing like static. So understanding these things and keeping up the market share, keeping up the required or planned growth requires funding, that is growth rate. And it doesn't suffice if you grow at 5% inflation, 7% GDP, 7.3% GDP, etc. It doesn't suffice because the returns what are expected from a startup, which inherently holds risk, which is a proposition of risk and return, high risk, high return proposition, requires rapid expansion, accelerated expansion. If it is not acceleratedly expanding, it is not a startup. It's a mature organization, saturated organization, traditional organization. And why at all anyone should fund you at a higher premium? None should fund you, none will fund you. Unless you show and you promise and you work towards that expanding returns, exponential returns, which requires growth, exponential growth. You do not grow that fast. That requires funding. So what are we funding, where are we funding will depend upon the stage of the startup and the instrument what we are using. Until 2001, ideas were funded left and right. If someone says, I have a beautiful idea, I want to be a startup promoter, he is not it, she is not it. I have an idea, owned or borrowed or heard or read. I have an idea, I want to start up. He was funded, she was funded. That was the craze at the time. In the world, there was a landmark year, 2021, the only year which saw 32 billion investments in startups in India. Nowhere else, including in US and Europe, could you see that kind of surge in investments in startup within a year with a low base. That's the year it set a new benchmark, and from 2021, we are seeing lower volumes in startup funding of 16, 14, 12, 10, and this year, 2025-26, we are expecting hardly 9 billion. 9 billion is not a small number, of course. 80,000 crores, 82,000 crores is not a small number, but because there is a comparison of $32 billion, we are thinking, yes, there is a winter funding for the startups. But no, ideas are now rarely funded. Other than in AI space, ideas are not funded. Then what is funded? Concept is funded. Your work is funded, effort is funded, and proof is funded. What is that? It's pre-seed funding has to be from the promoter himself, from his family himself, out of his savings, out of his past earnings. And you show that my product is this, and it is market viable product. Unless and until you establish and demonstrate your product as market viable, you will not receive funding. You should not expect funding. But this funding is still pricey. Do not think there is no risk. Do not think they are coming because product is ready. They are coming still. They are coming to invest still because it is risky and requires high returns. Expecting that high returns, are they coming to invest into your entity? Then comes seed funding. Seed funding is sweet. Now we're talking about seedling, in fact, because the market viability product is already built. It could be prototype. Now you're refining the product. You're building a team which can make the startup grow with higher level of operations. And you understand this is required in the market because market viability is proven, but how to make it fit into the market? Market viability is one aspect. Seeing that it fits into the market is another aspect. How well does it fit to stay put into the market as a perennial product or gets into the market as yet another product required forever? That is the kind of the market fit, what is included in the seed funding. Series A, no more seed, no more seedling. Seed funding is in a way seedling funding. Now you are in Series A, which means you have already proven revenues flowing. You may not have made profits. That doesn't matter. Here we are not talking about profits. We are only talking about the success, financial success in terms of revenue, in terms of holding the costs as you planned, in terms of holding the growth path or achieving the growth path what you planned and wanted to achieve, to demonstrate to your investors and for you as a startup promoter. This is to scale up, to reach the certainty. Unless So for a simple example, my favorite example, unless an idli restaurant sells at least 500 pieces of idli, it is not breaking even. 2 piece 10 rupee, 2 piece 20 rupee, 2 piece 40 rupee. Whatever be the kind of idli, whatever be the size of the restaurant or wayside cart, whatever is selling, 500 idlis plus minus here and there need to be sold to make the business viable for that entity. Otherwise, it is not, which means there has to be certainty which comes from the volume, which comes from the pricing power on your product at that volume. You may be able to sell one at a price. You may not be able to sell 10 at the same price. And it could be difficult or impossible for you to sell 1 lakh at that price. So what is certain is the volume at the commandable price. Those two as a mix is certainty, or the scale of certainty we're talking. To reach that certainty, if you could prove that it is achievable, you get funding in Series A. Series A passed. It's no more plant. It is, in a way, it is neither a frog or a tadpole. It is neither plant nor a tree, but it is an young tree, It is young tree what you're funding because it expands. It optimizes the customer acquisition cost. Now, this young tree can bear the fruits, what appear to be enlarging and swelling with the required pulp and water to be plugged and consumed. That is Series B, what you're funding. Series B firms are safe. They have the challenges of expansion. They have the challenges of reducing the customer acquisition cost. But as a business, it is safe. It is, in a way, profitable at the moment. Leaving the sunk costs, what we spoke about a while before, until BEP, what all is lost is not lost. It is capital invested. And now it's a tree, not a tree. It is a tree. Maybe still young, if not a mature tree, but it is a tree. And you don't use the word young before the tree. It's a tree. You are funding tree. If it is Series C funding, what do you fund? In this area, in this region, in this geography, it has proven to be viable, is successful, recognized, appreciated, and is making profits. That doesn't stop. That should not stop the startup. It has to replicate the same success elsewhere. You could understand the success model, what Britannia has followed region to region, what Bombay Dyeing has followed region to region, what Reliance with Vimal brand followed region to region, what recently Rapido did from region to region, having launched in 3 areas with first bikes, then to autos, then 4-wheelers. They spread that expansion from region to region after proving that at one region, after proving and understanding at one region how that can be a successful model. This is a formula of success, that you don't experiment everywhere and lose everywhere or fail everywhere. You experiment and understand at one region, introduce the pivots. The pivots are the changes in the plan and make the plan successful. Understand the viability quotient. And once you are convinced that it is and it is proven that it is viable, then you expand into other regions. The question now, by the time we became very popular in this area, it would be a sweet restaurant, a sauce, a startup, or let's say it's any other e-bike, etc. Before I expand into another region, will not there be another person emulating my theme, copying my theme, and starting in their area, the equivalent of Rapido there? Possible. That only tells you that the market is too big, and that lady has a share, you also have a share. Do not shirk from expanding just because there is another player. You have an edge of being in 2 places. A startup in 2 places, or the successful company, successful brand in 2 places is considered premium than the startup or the entity with presence only at 1 place. That gives you advantage if you have some competitors in other markets. They also promote the product before you go there. Your product is promoted there. Understand, they tell you that we are the equivalents of Rapido in Hyderabad, Bangalore. Maybe we are in Indore, maybe we are in Bhubaneswar, we are in Cuttack. But we are the equivalent of Rapido in Hyderabad, but our name in Cuttack. So what are they doing? They are selling your product and brand in that new area. As you enter, people would definitely look up to your brand, because that local brand, what was positioned as a duplicate within brackets to the Rapido, will lose its respect or may have huge competition from you, unless that is also good enough to compete with you and render the same service. If it is rendering same service, so be it. You have two players, there's a market, there's a big market, both will share. Least case, that much market is not there. We have to understand that your risk is now downsized. Your risk is contained. Look for more regions where you can expand like this and expand and have exponential returns. That's a part what we plan. Discuss in the boardrooms with the startup founders when we work on Series C funding. You may have entered at pre-seed, the seed fund, but you witness the seed series, Series A, B, C. Generally, after Series C, companies are good enough. Startup companies are good enough to go public, make an IPO. Do they make? Some may, some may not. Then what is the part that we could generalize as a normative for the startups to receive funding and to reach the IPO stage, or if required, post-IPO stage? It is here. Bootstrapping, funding by you. You are the startup founder and you are funding, and your family funds you. Sometimes a bit here and there, friends also fund you, but it is basically founder and family, and friends may not come at this stage itself unless he's almost like a family person. And until what period are you locking in your investment? Forever, all through your life. You can never decategorize yourself as a promoter unless you want it to be intentionally for some strategic reason. So all through, you are the founder of your startup. What is the return you expect? Unlimited. You want the best of the return. It can't be quantified. It is not 10, 20, 30%, 50%. It is unlimited return what you expect. And what is the exit you would plan? You would plan a part of cash out in private equity round or strategic investment round, or maybe at the IPO round through offer for sale, selling some of your shares at the time if your IPO, the planned dreamt IPO, has got a mix of OFS and IPO. Then comes Series A. This is the active seed funding. This comes not from the founder, family, friends, but comes from angel investors. Angel investor could be one of your family, but it is a professional angel investor category which will come understanding the growth or the possibility or the success proposition of the startup, what you already built and demonstrated. Generally, angel investors tend to stay for 2 years, make a killing of 50% odd return, normative return. It could be slightly low, slightly high, 50% return, and exit gracefully when venture capital comes, appreciating the growth of the startup thus far and willing to happily remunerate the exiting angel investor because they understand who is the angel investor. Do not think these words are simple as they are in English. They are not. There is a lot more insight into this. When a VC does its due diligence, it will understand who is exiting. They will scrutinize whether the person termed by you as the angel investor is really angel or devil, or a friend, family, father, uncle, or a lender. They are capable of understanding if it is really an angel who had invested and is exiting now after their investment horizon of 2 years, and deserves to be shown a proper red carpet outside with respect returns of 50% or whatever is the normative. If he is not validated as an angel investor, he is not validated, venture capital isn't fooled to let that angel investor go out, the duplicate angel investor or the namesake angel investor go out, and they would discount the valuation if you still stick to showing exit for the angel investor. That is the concept. It is not that someone whom you term is angel. It is not that someone whom you call is friend. Friend is not friend, angel is not angel. They have to fit into the category in the investment space, in the investment jargon, not in your family jargon, not in your friendship jargon, not in your tinkling glasses sounds jargon or the smoke sound of the puffs. It is here in the investment space. They have to fit and prove as a true angel investor. Then, yes, 50% return is appreciated. I have seen some deals where angel investors walked happily with 50%. They threw a party to the venture capital. They threw a party to the startups. Then families also joined in the party for the clinking sound, for the songs, for the zaz and other things. That's fine. But they should be a real angel investor. After this round, Series B will require scalability. You are funding to scale. It is already doing well. It will continue to do well. It is profitable, successful. But break-even losses may have to be factored in. It has to cross that path also, the real break-even, having recovered all the losses incurred since beginning until break-even point, and scaling henceforth, holding the same profitability. It is not just scaling. It is scaling, holding the profitability. If you are earning 20% return with 1 lakh rupees, 1 million sales, it makes no sense to earn 6% return with 5 million sales. Holding the profitability of 20% is key. That is success. Not top line growing, bottom line shrinking, or profitability shrinking. Bottom line also may grow absolute terms, but it is the profitability percent what needs to be held. It is not possible for a company to grow and hold the same profitability. All of us would do agree. However, we need to understand what is the extent of dilution or shrinkage, repression in the profitability. It can't be from 20% to 2%. It has to be the respectable returns in the industry with a premium. If this industry where you are operating is having a return on equity of 12%, your 20 can get down least of 12, but has to be slightly more than 12, failing which it doesn't make sense for you to expand. There are jolly well matured, saturated, and living trees where one can invest than take risk in this yet to be matured entity. So that is the scalability concept. It's not just scaling up, holding the profitability at the expected level, or even if there is a shrinkage, albeit with a shrinkage, above the industry average return. In no case, just matching or below industry average return. And angel investors or the venture capitals who come and enter this scale, enter this stage of Series B to make investments, they expect to exit within 3 years' time. And what's the return they expect? It could be anything, but generally 36% is respectable, logical, and reasonable return. Then comes Series C, which we spoke a while before. New products, new colonies, new areas, new friends, new glasses, new clink sound. Of course, yes, it does happen. Here, it's still venture capital. You may ask me, why are we still on venture capital scale? Aren't we deserving private equity? You deserve. You have to be a bit more patient to reach the stage of private equity. Founder, family, angel, VC, all are private equity investors. Private equity is a generic term. All are categories of private equity. But we don't use the word private equity in strict sense unless it is clear growth stage, having surpassed, having crossed the complete risk phase. So we have to wait. Now is still new products, new areas. We don't know. Johnson, when it wanted to get into distilleries, beverages, there is a bit of uproar and quite a long time story, about 40 years, 4 decades old story or 3 decades old story. They launched the brand and they invited IR because their otherwise successful baby products were told as received beating and got shrunk because moms, loving moms thought were apprehended that there could be a here and there mismatch and the objective or the directive of the management may go RE. So the product sales of the traditional leading products were taken a hit. Same thing happened for some restaurants which were traditionally into vegetarians. They entered into the new age red meat items, and they took beating because certain times perceptions matter a lot. So those things all need to be still tested. Therefore, there is still risk. In this area, it is fine. It may not be fine in new area. This product is fine under your brand, but the new product under your brand may not be fine. So the risk is still there in Series B investments as well. However, you are proven in one area. Your product is proven in one brand. Therefore, the risk, while still persists, is lower than in the previous Series B, Series A. Therefore, the VC which is entering in this Series C phase expects only 24% return and is patient enough to wait for 4 years. What is the exit they look at? Private equity, because private equity will come when the business is near matured and is consolidated and will grow at the expected pace. May not be exponential pace, but the expected pace. That is a stage when private equity will enter into any startup. Strategic sale can have any reason, and there can be no reason as well. IPO, of course, depends upon the volume of the company, the business volume, the market mood, and of course, the objectives of the investors to dilute their equity at this round or subsequently. Then comes Series D, the real darling round. Future expansion requires more funding. We are growing. Everything is good. We need only for expansion. We are in need of only expanding. We are catering 1,000 units. We want to do now 1,200 units. Therefore, we require funding for our 1,200 transformer units, 1,200 MLDs, not just 1,000 MLDs. That requires some solid funding, which should be at a benign expected rate of return at 18%. And the term what you expect the investments to stay put is 5 years. It is then come private equity. Until now, it is still venture capital. It is still venture, it is still risky. Now have you crossed the risky phase and you enter Series E, which is accelerated expansion. Paradise biryanis spread everywhere. People are coming from Dubai here, people are coming from Qatar, Saudi, US here. Why should they come? Why don't we go there and expand acceleratedly? People are compromising with other brands there, whatever is available, equivalent to Paradise. Why should they get convinced about equal to Paradise? Why can't it be Paradise? Okay, therefore I expand into these places. Instead of sending from here, I make expansion there. Future expansion, some new products, new areas could be catering new areas from the base. Then future expansions could be here and there. Accelerated expansion is having your presence rightfully, fully there and be seen as that place. What is the best example for this accelerated expansion in the world until now? Bata. Whichever country you go, all 86 countries, they are dominantly present. Every country thinks Bata is their homegrown brand. It's not. It is a Swedish, Switzerland brand. But every country thinks Bata is our homegrown brand. And everyone will feel patriotic, loyal when they buy goods there than purchasing from other brands. That is the kind of localization what Bata has achieved. That was accelerated expansion where the goods are made everywhere. Coca-Cola is also this example, but people still understand or identify Coca-Cola and Pepsi-Cola as brands from other regions. So therefore, we don't take those examples. We take accelerated expansion. Lima, yes, of course, to an extent, but it is through subsidy network and is considered to be still a foreign player in many countries. Then you come to Series F. After Series E, one has to make IPO. If one is not making IPO, there are some challenges. I'm not saying issues, challenges. And when there are some challenges, you have to approach and obtain institutional funding from institutions. Now, no more private equity, no more venture capital, no more seed, no more friends and family F&F rounds. Institutions like LIC, GIC, Mapletree, Temasek, Semcorp, which are okay for a relatively low return for a period until you test your luck of going IPO. They are willing to come and invest, but they're taking the risk on the timeline. Because the risk is on the timeline, anything from 1 year to 4 years, they generally expect higher return than in the accelerated expansion. Therefore, the return expected by direct institutional investors is 24%. What if 24% is not promised? The contractual structure will be built that way. And then comes Series G. Series G is, you're all set. You have to go IPO. You don't have funds to make the promotion, branding, the accelerators who would promote, or the reviews, roadshows, lift up the entity, lift up the brand, lift up the uniforms, all of these things. You need funding. For that, you take private equity, not institutions, and they expect higher return of 36%. They expect you to hit the market within 2 years, less than 2 years. Then there is something called a dirty round, which our investors, our hosts may speak the word dirty round, but down round, dirty round. So dirty round is stress funding. This stage may see slicing, trimming, hiving off, deproducting, all of these terms or concepts where you are selling this company at a down round at a lower valuation than previous valuations. Bridge funding could be static valuation. Stress funding will be at a lower valuation, down round, dirty round. Just because you have to stay put and see or separate loss-making products, lines, geographies, regions, etc. away, keep the others intact, repackage and sell to a strategic investor by way of a takeover, merger, or one of these structures, or selling the plant as a slump sale, etc. One of these structures which our friends are good at structuring and helping us. This is a master slide which explains the complete journey of a startup from its bootstrapped 1 rupee funding, your time funded, and until the merger requirement. Should there be any LBO, MBO, are all part of this Series G and Series H. Between these two or one of these two. To make investments into these startups, what do we need? Due diligence. Can I make to an extent? Yes. Can I make fully? No. Do I need an advisor? Yes. Only then can I be relatively better off, relatively better place in making my investments in startups. Of my 11 investments, 3 are very good. 3 are very good. What about 8? I am not happy because few got closed, abandoned. Few are reeling in losses. I am not interested in funding them anymore, having burnt my fingers at the initial stages. What about these 3? They are giving me the high returns, the pride, the network, the reputation. And I'm proud about those few startups which are doing very good. I'm damn sure they are going to become unicorns in the days. Thanks to a good advisor, good consultant who helped me in understanding and bringing things all together to understand and make a right package. The due diligence will include founders' due diligence, business due diligence, the due diligence of associates and the investors, the promoters' inter se structure and investments, and the cap table. Cap table ought to be with good color. You can't have a smuggler or a person reeling in ED cases, CBI cases, etc. on your cap table. Even if one is an investor, there is a way to tuck out of the cap table and keep your cap table clean. The pre-IPO rounds generally will see VCs or private equities guiding you to clean your cap table. Cap table cleaning is not an easy exercise. It requires tax ability, it requires contractual ability, it requires the regulatory understanding, and it requires the return risk trade-off understanding to convince the investors and to show them what returns they should expect and how they should expect. And what time period can they exit altogether should they prefer to. This is the cap table exercise, a very typical exercise. Sounds like cap table, simple word, but it has a lot of depth in it. And the achievements and progress of the investors. Are they cooked? Are they prepared? Are they dumped? Or are they branded up? Or are they real? Then the markets go. Can it stay put into the market forever? The revenue review is another key aspect which we cannot do. Due diligence, yes, to an extent we can. Revenue review, we can't do. Revenue recognition, revenue realization, the repeat orders, what are coming, references, reporting, and the valuation. Let me tell you one small example on revenue recognition. One of the entity where we were investing quite some time back, I'm talking about 8-10 years back, selling coupons at a discount for 6 sittings, 6 service sittings, recognizing revenue for all 6 sittings as if they made the sale now. What did they sell? One card, membership card of 100 rupees. They recognized 6,000 rupees sale, informing me that 2,000 rupees worth sitting service can be availed by them in the next 6 series because of this 100 rupees card, which means we sold a 6,000 rupees worth service. We are recognizing revenue now, we'll realize in due course. What if the person doesn't turn up at all? Other than that 100 rupees, you don't get anything. How can you recognize? So the revenue recognition has to be as and when the sitting happens. As and when the sitting happens and you receive the 1,000 rupees. There could be few cards which will not proceed any further after the card sale. There could be very few which may turn until 6th. By the way, it is the quality of the service, the product requirement, the market viability, market acceptance, which will decide if 6 sittings will happen. If all 6 sittings happen, it is excellent. Thereafter, you don't need to sell cards at 100. People will come in queues and you can recognize the revenue as per your projections. That insightful aspect cannot be known to you and me just like that. It needs a brilliant hand. What are the sources to find these good startups? Own sources. You have few in your friend circle, in your sister friend circle, in your father's friend circle, possible. There are some online portals which may also connect you. Slightly be cautious. References. If reference is good, if The messenger is good, message also could be trustworthy. Understand the message and the messenger both ways. Incubators, some incubators are really good. I'm part of 6-7 incubators and they're all good. Few of them are government owned in Madhya Pradesh and in Telangana and Andhra Pradesh. Few of them are private owned, but all are good. But are they to our satisfaction? Sometimes yes, sometimes no. Accelerators, which will accelerate the IPO exercise or the PE exercise, be cautious. How much ever good it is as an accelerator, as an investor, you should be cautious. As a startup, they'll be comfortable. And advisors and consultants, if they are underwriting, if they have a standing of 20 years service in the industry, I think they can't risk their 20 years standing in the industry for the sake of small fee. You can trust them. There could be small slip. So long as the slip is structural because of the logical reasons, I think we should partner and proceed with the same path. What instruments? Debt instrument, equity instrument, convertible notes, the equipment as a kind. You purchase the equipment and then give it on a lease, structure it as an equity. Loan to promoter with a share pledge or equipment lease with a share pledge. The instruments like SAFE of Y Combinator, KISS or ASA of UK and the other notes, the MP, etc., other notes, which are almost all of them equivalent, are also the new age instruments. By the way, because we have mentioned SAFE, the instrument which is designed by Y Combinator, which is one of the best incubators in the world and has funded a lot of startups in the world, including in India. SAFE is neither debt nor equity, but in the books of a startup, it sits like equity. Whenever the business achieves the scale required, will it be converted into equity? Otherwise, it can be deconverted or converted back, reverted into debt. And that helps both the startup and the investors with the flexibility required in the instrument for the growth and to book the returns and also to have the character of the instrument in the required shape. For the startup, it is equity. For the investor, it is debt. What more is required in terms of flexibility? And when it achieves the required pace of growth, the investor can convert it into equity. Sometimes there will be a mandatory conversion. Sometimes it is at the option of startup. But yes, conversion is made and you become an equity holder in a successful startup, failing which conversion itself would not have been triggered. So I don't know if I have taken more time. So thank you.
So yeah, thank you, Dr. Kishore. I think that was a very informative. Even I found it very, very interesting. I know we overshot, but I think it was worth listening to you. No worries. What I'll do is, since we are 10 minutes over, apologies to all the participants, but I would also understand that many of you would have found the content that Dr. Kishore shared today was very, very useful. Even for myself who have been following startups, I think some of these psychological aspects which you mentioned, right? I think that is not something that comes just by reading, but more by experience. And thank you very much for sharing with us. Okay. Yeah. And Dr. Nirakar Pradhan, he is actually he is part of ARIA convention today at the Reliance Geo Convention Hall in BKC, Mumbai. So he had something going on, so he had to leave early. But on behalf of him and myself and the Finkasturi team, I want to thank you, Dr. Kishore, for anchoring this program today. And also to Mr. Behra for his kind words. Appreciate it very much. Since we are out of time, I'm sharing the details for Dr. Kishore Nuthalapati on the slide. I request the participants, you can definitely reach out to Dr. Kishore directly on LinkedIn. Finkasturi's contact details are there. You can contact us by email, phone, WhatsApp. Also, if you have to give any feedback or if you have any additional queries that you want to be answered, we have put the link on the slide and also a QR code. We will send this out also in an email follow-up after this meeting. Thank you email to all the participants. Please do share your feedback. If there are any further queries that you want us to answer or Dr. Kishore to answer, we will look at those questions and we will answer them offline. Okay. My extreme apologies. I will conclude the session now because we are over time. But thank you very much, everyone, for participating.
Thank you, sir. Thank you, please. Thank you.